two extreme monetary policy exist in the world, I think we will see a lot of volatility between currency. That also will affect the stock market.
You heard the man. It's going to get volatile. From Asia News Weekly, this is Asia Now, a podcast featuring stories and interviews from the Asia Pacific region. It was expected to bring in nearly $3 billion a day in trading. 1 month after its launch, just how is the Shanghai-Hong Kong Stock Connect performing? That's today's conversation taking place in Asia now. Welcome everyone to this week's Asia Now podcast. I'm your host, Steve Miller, and I'd like to thank you for listening and downloading this week's show. November 17th marked the first day of open trading on the Shanghai-Hong Kong Stock Connect. It was supposed to channel more money between the two exchanges in those representative cities. At one point, some optimistic analysts predicted an almost $4 billion per day trading rate. What we saw was something different. On the first day, we only saw about $2.1 billion trading. The second day was less than a quarter of that. A month now has passed, and I think it's worth checking out to see how this potentially influential market is performing. For that, I'd like to welcome Stephen Cheng. He's the managing director of RHB OSK Investment Bank in Hong Kong. Mr. Cheng, welcome to the podcast.
My pleasure.
Mr. Cheng, if you would be so kind, could you please explain how the Hong Kong and Shanghai markets work and what the Stock Connect was supposed to function as?
Well, the Hong Kong market is relatively what we call open market. The Hong Kong stock market, I think most of the international capital can be in and out very easily because Hong Kong do not have a forex control. But for the China market, stock market, they have two exchange, one in Shanghai, one in Shenzhen, and they are more like host market to foreign investor because currency for China, the renminbi, is a control currency, not a FIFO currency. So the Shanghai-Hong Kong Direct, what we call this mechanism, is intended to let investor in both place to trade each other's market without directly open a security account in the opposite place. That means like Hong Kong investor or international investor, they don't need to open a security trading account directly with a mainland security firm. If they got a security trading account in Hong Kong, they can simply through their existing brokerage and then through Hong Kong exchange to buy a restricted list of A shares. And then that's issued the other way around. The mainland investor, they don't need to open the security account directly with Hong Kong brokerage in order to buy the Hong Kong shares. They simply just lead their own mainland brokerage account, then they can trade a list of Hong Kong stock directly. But the central spirit is also a bit related to the currency because renminbi is still not a FIFO currency. So every time Hong Kong investor, they buy A shares, they are supposed to settle in renminbi. But after they sold the A shares, they must convert back that renminbi into Hong Kong dollar. So that means the China currency still maintain their control status. It's still not a FIFO. I think this is the China's central government's intention to open up or what they call internationalization of their currency slowly because they are afraid without the forex control, a lot of wealthy mainland Chinese, they may pull out the money from the country that might affect their stability. So in terms of the chance, investment chance, I think it's enriched on both markets because some of the sector in China, They have no related listed company listed in Hong Kong. So namely is the military related sector, and also some of the railway sector, and what we call broadcasting sector. They are not listed in Hong Kong. They're only listed in the Asia market, the Shanghai market. So by allowing each other's markets participant to buy in either Hong Kong or Shanghai, it will increase the investment choice suddenly. So I think it's a good thing for both Hong Kong and Shanghai's stock payer. And also, I think through this mechanism, China is promoting their currency internationalization, because a lot of foreign financial companies, they already hold some renminbi as investment or as reserve. Some small central bank, like the Central Bank of New Zealand, they also hold renminbi as alternative reserve currency. So by allowing them to trade Asia through Hong Kong market, I think it gives them more choices and give them more intention to hold more renminbi. That will help the internationalization of the China currency.
That first week of trading, we didn't see the level of interest, the level of activity we thought we would see. Why do you suppose that happened?
I think the way how they structure the custodian forbidden a lot of foreign institutions to trade Asia through Hong Kong or through this mechanism. Because a lot of institutions, after they bought the share, when they pay the money, what we call settle, usually they will transfer their shareholding to an independent custodian bank. Usually are the big names like Citibank, Standard Chartered, HSBC. This mechanism is intended to protect the small investor. Let's say unit trust investor. They can protect the small investor because the independent custodian bank's arrangement ensure when certain fund management company go bankrupt, but their funds unit holders' interests are protected by the independent custodian bank. Because they can simply go to the custodian bank and claim the shareholdings and then sell it and then distribute that to the unit holder. But initially, the Shanghai-Hong Kong Direct, they don't allow this kind of arrangement. All the shares you bought through Hong Kong, all the A shares you bought through this Shanghai-Hong Kong Direct mechanism will be under a nominee account of Hong Kong Stock Exchange. We sign with the Shanghai Exchange Clearing Company. So that means the institution cannot transfer their holding, even they pay the money, to an independent custodian. So that forbidden a lot of formal or more traditional institutions to participate this and buy the A shares through this mechanism. So that's why the utilization of this mechanism is very limited. So that explains why what we call lost buy money, the money flowing in from Hong Kong to buy A share. But for the lost buy money, which means the mainland investor through this mechanism to buy Hong Kong stock, the utilization is even lower. I think the reason is the Chinese government set a very high limit for people who qualify to utilize this system. They set a limit of 500,000 renminbi as a qualified person who can utilize this system to buy Hong Kong stock. So not a lot of Chinese citizens, they have 500,000 renminbi in stock portfolio. So that also forbidden a lot of people to participate in this what we call southbound money to buy Hong Kong stock. So I think that explains why the utilization are so low. I think at the very beginning, the design of this Shanghai-Hong Kong Direct didn't take into account this kind of restriction. Can be very hindering the interest in utilizing it.
Well, what do you think would be the best way to overcome those restrictions to get more people to use the system?
I think for the lost buy money, for foreign money to buy Shanghai shares, I think the simplest way is for the CSRC, the China Security Regulatory Authority, to allow the foreign institution to find certain custodian bank in China, or maybe if you don't allow foreign company to act as custodian, choose the big four Chinese bank to act as custodian for foreign institution. That may solve the problem of the independent custodian. For the lost money, it's easy. Lower the restriction, not 500,000. Say 100,000 renminbi. Everyone who owns 100,000 renminbi can participate the lost bond trade to buy and sell Hong Kong stock. So I think this is the easier way to do it.
All right, one last question. With 2014 coming to a close, how do you feel about Asia's financial future for the next year?
Well, I think you will see a lot of volatility. It's mainly because we are having two types of environment for the money supply, or what we call QE situation in the developed world. We see the U.S. tightening their monetary policy, but at the same time, both Japan and Europe they are going to print more money. Even China, they will lower their interest rate or lower their bank's reserve ratio, which basically also means printing more money. So with this kind of two extreme monetary policy exists in the world, I think we will see a lot of volatility between currency. That also will affect the stock market.
All right. Steve Cheng is Managing Director of RHB OSK Investment Bank. Thank you very much for joining me today.
Welcome.
And now I'd like to hear from you. Do you dabble in Asian stocks? If you do you trade in Hong Kong or Shanghai? What's your impression of the Shanghai-Hong Kong Stock Connect? Please share your thoughts in the comments on Facebook or Twitter. If you haven't found us on Facebook, that address is facebook.com/Asian News Weekly or at Asian News Weekly on Twitter. You can even send us an email with your questions, feedback, or even audio comments. Just drop a line to podcast@asiannewsweekly.net. If you enjoyed this week's episode, please do me a favor and share it with your friends. You can subscribe to this and other podcasts on our website. Just click the tab at the top that says subscribe, or those big iTunes and Stitcher buttons. Subscribing is free, and when you do, the next episode is delivered automatically to you. One final note, since Christmas is next week, I will be taking the week off, but don't worry, I'll be back on the 31st with a brand new episode of Asia Now. That being said, I hope you have a very happy holiday season, and I'd like to thank you once more for listening. For Asia Now, I'm Steve Miller. Asia Now is licensed under a Creative Commons Attribution 4.0 International License.